Hi folks, it's Adrian CryptoBurb speaking. Welcome to today's Friday webinar. Best of love and greetings coming to you straight from Portugal. Eddie's at a beautiful surfer spot, beautiful village that it actually just comes a lot up with nature. And that's where I am right now. Best of love, guys, to you. Well, I'm really excited and really happy because today's workshop webinar is going to be a little bit different. I'm going to teach you and show you a couple of good tricks they're going to help you basically understand the relative strength aspects and how we can apply that in technical analysis in the financial world in order to predict future trend reversals. If you want to hear about this, make sure you stay tuned. We're going there right in a second. Welcome. Again, it's Aidan CryptoBurb. Welcome to this stream. Welcome to this beautiful Friday day. I want to tell you guys something that is of exceptional value. Well, relative strength studies is not something that is commonly mistaken or confused with relative strength indexes an RSI, right? Which is a measure of a momentum, especially within a range-bound movement that kind of like tells you when the market is overbought, oversold, and you can trade within the frames. That's not exactly what the relative strength in its pure form is. Relative strength is a very interesting study that has been discovered. That was discovered a long time ago, especially when there was an overall concept of intermarket analysis resurfacing. And one of the pioneers was definitely John Murphy, the one and the only John Murphy that you probably have heard of. And intermarket technical analysis includes a study of many different aspects, many different types of financial markets that actually appear to trade together at one times and trade opposed to each other on the other times. And this is very interesting, right? I wish markets had some sort of like fixed rules that you could apply that could tell you, or if A happens, then do B, or if B happens, then go and sell on the point C, and so on and so forth. I wish it was the truth. However, the situation really works very differently in the real world, in the real circumstances, because the world is full of noise. Each and every single second, there are almost infinite, uncountable amount of details, information pieces coming into the markets, into financial markets, and each and every single aspect, such as bad weather or good weather, or whether you watched a good movie or had some laughs at a comedy show right before you start trading, it actually impacts the way you think. It impacts the way you behave in the financial market. So there are a lot of uncountable reasons for the market to go up and a lot of uncountable reasons for the market to go down as well. And somehow the financial market cycles then tend to prove over the time that some markets tend to oscillate in the same directions together. And on the other occasions, they tend to counter influence each other, right? So it's a very interesting study because there's no one fixed rule. There is no one situation that is going to, or rule that is going to last forever, that Bitcoin trades exactly the same like stocks do, or the other way around. So here today, we're going to actually focus a little bit more about understanding the relative strength study. Let's have a look at this very significant chart that you can actually just spot that it shows you that stock market performance depending on the sector of the S&P 500 of the Standard & Poor index, which is actually telling you, well, some piece of a story. And by the first glance of it, you can probably tell that this performance chart, ever since January 2022, it reveals that there is one significant outlier. This outlier happens to be energy. So energy sector is definitely something that showed distinct improvement or distinct leadership, distinct positive difference, right? And it is a huge difference of 70 percentage points almost versus the entire rest of the market. The entire rest of the market understood as the other sectors of the S&P 500, right? So what does it tell you? Well, it tells you that relatively, when you compare one with another, there's a distinct chance that this strength of the market is very rampant, is very apparent, is something that you can easily spot, as opposed to the entire rest of the S&P 500 sectors. So long story short, you can tell and admit that the energy sector of the S&P 500 is on the relative strength basis way stronger than the entire pack of the S&P 500 sectors that remains. Right, so there is this significant comparison, this comparative analysis that is telling you which one performs better for the financial markets, for the assets, for the index, for the ETF, or for a single security. and you know which one actually just moves, on the losing side as an underperformer, right? So I think it's very essential to understand that anytime you talk about relative strength, you talk about comparative analysis. And you may ask why it's become needed, why there is even a need, to spend time on understanding the relative strength study. Well, the reason is, and the answer is that it's becoming more and more strongly encouraged by the market technicians, by the traders, by the investors, by institutions who deal with financial markets. And ever since the free market kind of like came into action, the free came up basically in the world, it was definitely strengthened, in the 50s and the half of the past century, in the 20th century, the market started kind of, connecting with each other. The market started to, over time, become increasingly more attached and connected, interrelated with one another, right? Mainly because the entry barriers, were kind of like diminished, destroyed, basically removed. And as soon as they were removed, some traders who create the markets basically started understanding that there are certain cycles, and those cycles tend to appear independently or dependently on something as simple as seasons in the year, right? So for instance, wheat market or commodity market is going to strongly depend on the harvesting season, on where you actually have a lot of good weather. That is typically where a lot of growth in the food market comes up, from. So I would argue that it's very important, significantly important, and it's becoming more and more important each and every single day to understand that the Bitcoin, just like any other asset class or cryptocurrencies as a whole, are not trading in vacuum. Not a single investment market, financial market is trading in vacuum. It actually just deals with a lot of different market decisions. When you're a trader and you're about to make a trade, you face a decision time where do you put your money, right? To which basket you want to allocate your eggs? And there are almost infinite amount of choices, right? Because there are so many cryptocurrencies. So which one is going to be? Well, obviously you would want to pick one that is performing the best, the one that is giving you the best returns, the one that you're going to get rewarded the most with, right? It would be counterintuitive and counter logic, so that if you go and pick the worst performer, right? Or so that you go and actually just decide, okay, I'm seeing and spotting the worst chart in the history, and that's where I'm putting my money, right? That's not specifically the type of reasoning that you would have as an average, let's say, average out all the traders that all the traders that you've ever talked to, and an average person, average trader, market participant is not likely going to make such decisions this way. So there is this entire momentum principle. I often refer to it and recall to it as the momentum is this phenomenon in the market that comes from a little bit from the self-fulfilling basis, from the pattern creation, pattern recognition, but also it comes from some certain natural phenomenon. Like I said, especially when there is a lot of behavioral biases, which are like either cognitive or emotional, they like to stack up, one after another, layer after layer, and basically cause these so-called self-promoting loops or positive feedback loops. And what happens is, when you see certain market that improves a lot of people are going to move into this market to decide, okay, I'm seeing and I'm watching this market is going up sharply and strongly. A lot of people are feeling this so-called FOMO, this fear of missing out, this loss aversion is calling to them, this recency bias, regret bias for missing out, on the previous rally. So they decide to hop on the bandwagon just because the other people are coming into it, rather than there is any other, logical reasoning behind it. So because of that, I would argue that those trends like to ramp up even further beyond. So let's have a look here, right? You can tell that overall, whenever there's this distinct relationship, distinct strength shown over the course of the past, over 360 days, for the energy sector, and the relative weakness, comparative weakness for the entire other series of the S&P 500 sectors, then this is telling you, first of all, that the market is not really efficient. It's not moving kind of like, on the step up, step down, right? it's not fully efficient, it's not fully logical for the market to trend like that. At times you would see some very consistent moves, some very consistent moves which are going to remind you of this. However, most of the time, those, especially in the longer term, those markets like to move in some sort of accelerated movements, right? So instead of going and kind of like pursuing this same step, same angle, they start ramping up. They start kind of like collecting this strength, this internal intrinsic force that pushes the market better and faster beyond, right? So it's often, especially in the Bitcoin market, that you see such rampant movements, such exponential rallies, such vertical movements that basically seem to have no stopping, right? And the further and the higher it goes, the more people would be feeling this so-called FOMO, fear of missing out, right? And the further it goes, then your brain will go, is going to make it and tell you, okay, at this point, you're going to have a look, okay, this market has shown so much strength, it's shown so much pump, that there was like so much significant move up, that it needs to continue, that is going to continue. This sort of like a saliency, this extrapolation into the future is going to trick us, right? Because eventually, the more the market has been, already gone through, right, on the way up, the more likely eventually that you're going to buy the top, right? Because, well, the bigger the gains you had already given up. So all those things concerned, I would argue that you have to be realistic about the markets, that they not move in a straight line. They don't move even in a straight line, on average. They tend to accelerate to the upside and also to the downside, right? You can see that in this example, right? So it is not a single line. It is not a straight line. You have the periods where it kind of like declines much more than on the other episodes. And for this specific reason, this is exactly what we call the momentum principle, right? The momentum principle is this nature of the market that is that is allocating that when people, a certain amount of people, are going to start, imposing this viral effect, this network effect, and they start ramping up all together, right? Because there is demand, but because there is like some time restrictions, or there is like some other scarcity factor to it, they would start and create bubbles. And those bubbles come from the fact of the momentum. And this momentum is exactly, well, what you may also kind of like know a little bit from your school, from your middle school or something, under the second Newtonian dynamics law, right? Which basically told you that when there is this impetus, whenever there is force, and this force can be money in the financial world, and as long as there is this force pressing, there is the people coming up into the market, making up the situations, right? Following and FOMOing into a certain market, then this generates certain thrust, this generates certain movement, certain dislocation. And if enough people into the market, then this is going to create certain tide, certain movement, certain momentum, certain impetus, which is hard to stop, right? So this generates certain thrust, this generates certain quote unquote pressure that it's self-sustaining. That is, momentum generates this thrust that is going to elevate higher and better in the direction of this so-called breakout. So knowing of that, again, you have to be realistic that this is the origin of this wise saying in the trading world, that that you don't want to fight the trend, don't want to fight the Fed, right? Because otherwise they create the trends. So the momentum and trends are irreplaceable. The momentum and trends are very apparent in the markets, right? Trends, they by nature are defined to continue to persist. This factor, right? Which otherwise those other range-bound movements, kind of like this one, they don't really have it, right? So those trends, like this one, from January 2022 all the way up to June 2022, those are very, very strong movements which will continue to move because of their intrinsic persistence, right? And this is exactly what creates that one market performs better than the other, right? So if you add this natural momentum principle, that there is going to be always this market that is going to be stronger, there is going to be having more trend, that is going to have more attention from the traders, more also kind of like attraction is going to be much more attractive, then this is going to soak in with more money. This is going to accelerate more in the direction of a breakout because it also connects with behavioral biases. So all the things concerned, when you see and spot a trend, it comes with momentum. It generates a momentum thrust, which is a little bit self-fulfilling, self-sustaining. And because of that, you don't want to be on the wrong side of the trend. So if you see such a single distinct leadership from the energy sector, right? If we take it back to the S&P 500 sectors, and you tell me that there is this entire section of the S&P 500 chapters that are fairly distinct and fairly, different, and in fact heavily underperforming 70 percentage points, right? Then, well, where would you allocate your money, right? The simple answer should be done to this, because you want to stay invested in something that shows strength, not what shows weakness, right? You don't want to allocate your money on something that keeps losing the bets. And for some reason, in the nature is in the moment, in the understanding the momentum, this thrust, this self-fulfillingness of the trends, as well as behavioral biases, right? This tells me that my money, my portfolio would like to be more allocated to something that shows strength rather than to what shows weakness, right? So this is following upon which you can base the trend following systems. And long story short, that's what I do as a trader. That's what I do as a position trader, middle time frame trader. I chase the trends. I don't need to be early. You don't need to be kind of like, just on a reverse so that you assume, okay, this looks like a bottom, this looks like a top, so I better get in or get out. In fact, my job and the most profitable job for any trader that could get is proven to be of trend following. And trend following means that you wait for the resistance in the market, that you wait for the thrust to appear, because eventually it will appear. It will appear. Why? Well, the answer is because eventually there is going to be the seasonal pattern that is going to resurface, right? Just like the seasons, just like autumn, spring, winter, and so on. That is basically going to make certain trades elevate better than the others, right? That is going to make distinguished and distinct strength reappear against the other stocks or the other assets. So this is the type of relative strategy that you want to really master, right? And by understanding which markets tend to have the strong leadership at present time versus the underperformance of the other asset classes, well, that's how you can construct your portfolios, right? Let's have a look further. The very simple understanding of relative strength in application is by comparative analysis of one security versus another, right? So in order to compare relative strength of one asset against another, let's say Bitcoin versus dollar, or one Bitcoin versus S&P 500, right? To decide, okay, whichever is showing more strength, whichever is stronger than the other, because that is going to tell you not only about a little bit of appreciating powers that it has, predictive forecasting powers that it has, but it also tells you about the portfolio allocation. You don't want to be overweight in your portfolio. You don't want to have overinvestment into something that shows a lot of weakness. You want to stay invested and strongly invested in something that shows a lot of strength. So you would buy into something when it shows you a significant change and shift in the relative strength ratio when you compare price of one security to the price of another security. And here, for such an instance, is a very interesting chart of what we know as an XLI and an XLP. XLY and XLP are the ETFs for the S&P 500 sectors, which are just the ones that you actually just reviewed here, right? So if we go here, the utilities, the staples are in the purple. This is the consumer staples, right? And the consumer discretionary, if we go further, then consumer discretionary is going to be purple, like deep purple. And it's showing you the minus 35%, maybe minus 33% to be more specific. So we have basically, we're basically saying this, the consumer staples is minus 5% and the consumer discretionary. And those are the type of stock sectors that one of them is considered cyclical, that moves along with the market cycles, and the other one that moves regardless of the market cycles, that moves forever, that moves, in its own kind of like nature, irrelevantly of that market cycle position, market cycle, phase, right? Mainly because they are well established, they are very big companies, long lasting, and they pay out the dividends and so on and so forth. So there's a lot of stability, and they are always in demand, such as um, you know food, beverages, right? Clothes. That's something that you always are going to need versus the cars, right? If you for instance don't fancy a car because you don't have really much money, then you can wait, not to have a car. You can wait and not have a car for some time, but you're not going to be able to skip on the clothes. You're not going to be able to skip on the beverages or on food and so on and so forth, right? So for this reason, when you compare and perform a comparative analysis or relative strength ratio of XLY, which is the cyclical stock, versus XLP, which is consumer staples, right? Then this basically tells you, or consumer staples in this specific case is a basic needs products, right? Consumer products are in the basic needs that are always in demand. This is what I'm specifically referring to right now, XLY versus XLP. Then this, by measuring the ratio, and at this very present moment is at 1.91. This is what the ratio suggests, right? Of one price versus another, it makes sense to help, and it helps you track the significant changes, right? Well, when you apply 200-day trend, 200 mean moving average, then it tells you that it's continuing this declining. It's continuing to decline. It's continuing to decrease over the time, right? So what it tells me is that the relative strength ratio of XLY of cyclical stocks, or risk on stocks, if you will, versus consumer staples, which is risk off, right? Then you can tell me, well, by analyzing the charts, you're going to be able to tell me and to tell to yourself that the XLY is losing versus the XLP. The XLP is a leader, is showing leadership versus the XLY. XLY is underperforming, and hence the trend moves down, right? So by knowing this, what it tells me is that unless there is the significant breakout over the 200-day average, then it's a safer bet to place your portfolio weight more and allocate it more to consumer staples, right? To risk off, rather than to XLY. Well, there are a couple of reasons. First of all, because 200-day trend is continuing to decline, which tells me this is a bear market in this relative strength ratio. And it also tells me, well, that despite there's this local very promising kind of like a breakout attempt, that it tells me that this is an overall downtrend, right? And this is a bear market defined on average, and it also kind of like continues to make lower highs and low lows, which classifies this as a technical downtrend. And as long as you see this tells me that the risk preference of the market participants or of traders in the financial markets is more risk defensive still on average. Locally, the risk on has been actually just more risk offensive preferred, right? Because it's been inclining, the ratio has been inclining, which means that XLY was gaining the strength relatively and comparatively versus the XLP, which is the consumer staples, the defensive stocks, right? Then, well, what it means is that we are looking at a little bit of a local spark and a little bit of a local shift in the preference of XLY versus XLP on the risk on has been just slightly, improving while it's still within an overall downtrend. So if you are a short-term trader, you will be at a significant and promising ratio, right? Incline and move to the upside locally over the past couple of days. However, if you're a long-term investor, of course, long-term investing much more often than not brings better returns, you would be looking, and you cannot really just, be indifferent about the fact that it continues to decline on a 200-day basis. It's a very consistent trend line. It's a very consistent downward move, right? And as long as it is, this tells me that on the past 200-day basis, on the long-term basis, there is still much more preference and outperformance from the risk-off environment, from the defensive stocks, rather than towards or in favor of the cyclical stocks, right? So what is the conclusion that I can make out of that? First of all, that I don't want to overweight my portfolio to risk on to risk on asset classes, right, or assets. I don't want to put too much money of my portfolio overall, like into Tesla, right, which is one of the representatives now for the XLY, or something that can be associated, right, as the durables somehow. You don't want to kind of like spend too much of your money because of this momentum principle, because of this tendency to persist, to move further in the direction of the breakout. Well, and at the same time, you want to still have a lot of reserves. You don't want to. You have to have a lot of risk of preference within your portfolio in order to align well with the market tells you, right? And overall, you have to remember, and it's good to remember, it pays off to remember that the markets are moving and are moved by the expectations of traders of what the future looks like, right? So it's not necessarily this ratio, it's not necessarily telling you, okay, the markets are, the markets is right now, and this relative strength ratio kind of like specifically tells you it is a visual representation of what traders imagine to be in the future, right? They want to buy something not because they are making money on it right now, but because they can make money on it in the future. They want to buy something not because it's expensive, but because it's cheap and they can make money by selling it more expensively later. I hope it makes sense, right? So the future, that the markets are driven by the future trends, basically, the trends are driven by the expectations of future prices. This is the real situation. So by observing and applying this relative strength study in the technical analysis, in the way that you measure your finances, that you control your risk, that you decide about your portfolio allocation, you want to be alerted that and reminded that, you know, seeing this XLY versus XLP relative strength friendship continuing to decline on the long-term basis, well, no matter how short-term positive signals, how many positive signals there are on the short-term basis, now that it tells you that it would not be wise to counter trade a trend and position yourself against a trend which is such an aggressively downside oriented, right? Because those trends are like spinning tracks, basically. This is the second Newtonian law of the dynamics as well, right? If there is a spinning track, then, as long as you keep your pedal gas on, right, and you keep your foot on it, then it's going to continue to move and accelerate. Otherwise, if you take it off, then it's going to start to decelerate, right? But as long as you keep the thrust, as long as the markets continue to move, continue to have this money, this kind of like money generating factor, this attention, this overall, it's within the range, it's within the reach of the people. People can reach it. It's not barriers. It's not kind of like on the embargo or something. And then it likely is going to continue to move within the same direction. And altogether, I think it's signaling you that it wouldn't be wise to counter trade a situation where, on the long-term basis, the consumer staples are outweighing or outperforming the XLY, right? The consumer discretionary. So the risk on is losing on the long-term basis versus the risk off. So investors are, on average, much stronger or much strongly allocated to defensive sectors, to defensive outlooks, which prepare them and share information about their expectations for what the future looks like. And whenever there is increased demand on the defensive stocks, which are risk off, which are risk defensive, this means they are preparing for some unpleasant future. This is what it tells me. So would it be so wise to counter such aggressive and dominant tendency? Well, the answer is no. Right, so just looking at a simple chart of XLY versus XLP can tell a lot about the preference of a single stock, right? Which one would you prefer, XLY versus XLP? And the answer is XLP, right? So the risk off outweighs and outperforms the XLY, the consumer discretionary. And by same way, you can use that in the predictive analysis to have some forecast, to have some expectations. And the XLE, which is on another hand, the energy sector for the S&P 500, it was giving you signaling significant trend reversals before they came up to happen. That is very interesting, right? I was preparing a series of tweets on this relative strength ratio breakout, right? Here is an analysis, comparative analysis, relative strength ratio of XLE versus SPX, which is the large cap index, S&P 500 index, right? So by looking at it, let's have a look. By looking at similar movements, on this momentum kind of like based chart curve, by observing certain breakouts before they even happen in the price, you can anticipate certain reaction in the future. And relative strength studies often have this preceding value, this actual forecasting value that can make you money. This is something that I had used multiple times, in order to decide whether it's a good time to invest in something or not. So here, have a look at the upper curve, which represents the relative strength ratio of the energy sector versus the S&P 500 index, and the similar breakout. Let's say let's have a look at the breakout. When the breakout happens in time on the timeline, this is where the breakout happens, right? Over a specific trend line, which was of course showing a little bit of a sideways, then on the relative strength ratio side. And what happened on the breakout day? Where was the price of the actual XLE, which is the candlestick chart, at the moment of breakout? So if we have a look, then what is going to happen, what we're going to notice is that this breakout on the relative strength ratio, when it happened like here, right, it had a preceding value and a preceding forecasting value that despite there was a local slide to the downside here on the XLE, right, it was actually coinciding with this relative strength spark and thrust up. So this is very significant. This is very significant because even though the market has been, the market was at the time slightly decreasing, it was slightly moving down, declining, by seeing the relative strength ratio breaking out to the, you have taken a decision that you want to invest in something that is signaling outbreak leadership versus the S&P 500, which was showing more weakness relatively. And you would have actually bought XLE, which is the ETF, at around 82, maybe 80. And you could have made a lot of money riding it somewhere towards the topish area, right? So by observing that, this is a confirmatory evidence. Of course, there is a lot much more to be understood, but what it tells you is that if you apply relative strength studies well in the markets by understanding that its nature comes and origins from the existence of trends, the existence of momentum, of the self-fulfilling loops, of positive feedback loops and behavioral biases that make people act irrationally, that make people ramp up on the already, exhausted and elevated trends and buy instead of sell, right? Then this is the exact reason also why, with the overall propagation of technical analysis in the 20th century and the use of computational power, in some forecasting tools and statistics and measuring the financial markets and big data and so on, then you could probably understand that there's a lot of value hidden behind the such a chart like an XLE versus S&P 500, right? And come again, and this is like not one in a million situation. It happens a lot. The relative strength studies, because you show comparative analysis, one versus another, they often precede the actual price outbreaks on a specific security. Because when one moves faster or better than the other, it's going to naturally show much more strength and more preference, which in fact and in turn may encourage more people to come and pick the stock that is more attractive, that is moving faster and better. This is the typical nature of human decision making, right? So you would want to listen to a song on Spotify which has million views, right, or million listen, here's listens, measures, whatever you name that, units, other than or over a song that has only one view or one listen. So So all of these, kind of like tell you about the preference and how suggestive decisions, are made. That if people see that there is strength hidden in one asset or in one security over another, they're going to naturally go and prefer the one that shows strength, which is generating this self-fulfilling and self-sustaining thrust and momentum, and makes this trend to continue and persist in the same direction. So it's not wise. The conclusion is that it's not wise to concentrate or give up on relative strength studies, especially when they signal you a lot of value on the preceding breakouts, right? Because thanks to observing relative strength breakouts, relative strength trend shifts, you can really anticipate and prepare yourself. It's like a trick. It's almost like a mystery, like a special hack trading, that you can observe the relative strength outbreaks and decide accordingly to buy a security which starts showing and displaying more strength, right? So it's very interesting, actually. It's very interesting because then there is this entire context of understanding that relative strength studies are very, I should say, difficult to measure, right, in a very complex manner. And the best idea is to use them in a simplistic way, in a very simple way, right? So, but just using something as simple as the ratio of one security versus another, dividing one price of an asset versus another price of an asset, especially if they are close together, they are priced similarly. If they are not priced like 1,000 to a million or $5,000, or just like you would compare Bitcoin with, $20,000 versus, some penny stock that would be worth like $1 per share, then relative strength is going to be, of course, like 20,000 units. So it's not going to be too comfortable to operate within big dissociated numbers. Otherwise, if you have the numbers close, which is like an XLY, XLP, then you can observe that this relative strength ratio is basically telling you good numbers which are put close together on the map, right? So here, again, observing those trends, observing those breakouts in the direction of the trends is going to often make you a lot of money because you are one step ahead of the curve. You see something of a change in intrinsic performance, relative performance of one asset versus another before it starts reflecting that in the price, right? So you can spot the breakout before it actually comes. How cool is that, right? So this is actually something that you can verify. I was talking about it on my Twitter publicly, and I was making those so-called predictions, guides, ideas, concepts of the breakouts, and so on. You can scroll it through my Twitter. You're going to find it. It's very interesting because it definitely works. Besides, there is this question. There's this question of understanding, the entire universe of assets, right? Because there's not just kind of like XLY and XLP. There's an entire variety of assets or sectors that you can choose from, right? So if you don't compare two, right, perhaps maybe it's not XLY or XLP that are going to be the best, but just maybe it's going to be something completely else that is going to be even stronger. And your job is to allocate to your portfolio the weights according to the strength, right? So that you can benchmark something that you want to be long on your portfolio on something that shows strength, and short on your portfolio on something that shows weakness, because you know that those are going to be moving in opposite directions. The strength will have the persistence to continue in the same direction, and the weakness is going to have this natural perpetuity or this natural continuity, right? That is going to continue to show the weakness. And just like that, the relative strength or the relative strength ratios are also to be shown within the RRG, which is by my friend, great, amazing trader, investor, beautiful story, what an amazing military experience he's got. Julius the Campaner. And on the relative rotation graph, ROG, which is a very simple, nice visualization map for this variety of different securities or different asset classes, and showing this comparative analysis not between two asset classes, just like consumer discretionary and consumer staples, but by understanding the relative strength study in the map in the entire universe, right? So it's going to tell you, and not pick, just make the best pick between the two the asset classes that you're given, that you're about to decide, but of the entire pool. Because just maybe if this is not an asset A or asset B, it may be asset F or asset G that is going to be the best. And your job the underperformer to go short on. This is from a portfolio management perspective. So what it tells me is that leading quadrant, which is very rich with relative strength momentum, which is relative strength rate of change, basically how fast it changes, and the relative strength ratio, right, which is basically all rated against S&P 500. So by default, all the measures are shown that each and every single sector like this, XLI, which is the industrials, right, sector, or the basic materials, raw materials, XLB, it's put aside or put next to S&P 500, which is in the very middle intersection of the axis. So this is by default XLB versus S&P 500, XLI versus S&P 500, and so on and so forth. So as long as there is a lot of relative strength momentum, rate of change, it's strong, it's accelerating, and it's very rich with relative strength itself on the value, well, then it's tells that anything on the right of the S&P 500 on the relative strength axis is in trading is outperforming the S&P 500. So the answer is that you would want to be long on anything that is on the right side, on the right hand side, and short on anything that is on the left hand side. However, you can still make and specify a preference because you want to be long in something that is extremely strong on the relative basis to S&P 500 and something that is additionally gaining on strength, so you can trade in the direction of the breakout. So as such, are hidden or are placed in the leading quadrant, right? The leading quadrant and the weakening, where just as the name suggests, you would preferably want to be in the leading quadrant for something that you want to long, and you want to short on your portfolio underweight on something that is lagging. So the consumer discretionary on the past 5-week basis, that's what it says. As long as or as well as USD, the dollar, or just for instance, to be shown as examples, of what could be shorted on your portfolio, what you could, being portfolio underweight when you have, so much weight allocated to it is basically also an economic equivalent of being short, right? You have to literally short it. You just can have more weight allocated to something that shows leadership, just like basic materials, or XLI, which is the industrials, or XLP, which is consumer discretionary, consumer staples, right? And you would not want to be so much overweight. You want to allocate much less weight to, let's say, consumer discretionary, right? And the way that these stock asset classes move, is something that we call a sector rotation. You can tell that over time they change. The leaders actually are moving to weakening quadrant, right? And the weakening quadrant moving to lagging quadrant. And there's very significant chance, there's very big chance that these markets are going to continue to move from one quadrant to another, right? That this is going to be some sort of like a spiral. That once there is a leadership, eventually it's not going to continue to move up and strongly forever. It's going to give off a little bit of steam, give away a little bit of strength, right? And other ones are going to come up and relatively reclaim some strength that has been given away. And in its place, it's going to come up with another, the market is going to come up with another choice preference of leaders. So you want to be long on this quadrant and short on this quadrant, if it makes sense, right? So just again, you can tell that XLE, which is this relative strength study of the RS momentum and the RS ratio, versus S&P 500 is showing the best preferred strength and leadership. That's something I would, if I were to pick, that's exactly the type of the market that I would pick to overweight, to allocate a lot of weight percentage, weight of my portfolio into it. Much more preferred, let's say, that was the time on the timeline, right? However, it changes over the time. But at this specific time, I would allocate much more strength to XLE, than to, let's say, XLK at this time, or consumer discretionary. And you can tell that it changes over the time, right? Because those markets tend to rotate. There is this preference that chases, that people tend to prefer the leadership, and the leadership is going to, whatever loses the steam, they're going to change and make their preference renew, right? Anew. So that XLB and XLI and XLP are the answers, let's say, to be long into, right? And XLI, XLY is something as a consumer discretionary, as the cyclical stock, as this risk on asset, is something that is on the weakening side, or something on the lagging side. So you want to be short or underweight on something that is on the lagging. I hope it makes sense, right? But all of that is just to tell you how very valuable the relative strength studies are. And you can make really a lot of money, from it if you apply it well, if you really apply it well within this technical analysis context. Technical analysis, you can see that this is not a single kind of like a self crystal ball that you can going to be just that you can use to tell you like what the future looks like, or that you're going to be able to guess like the weather tomorrow, right? It doesn't work like that. However, it tells you that if there is this significant preference on one security or for one security versus another, or there's this significant, rejection for another security, then it's going to make those preferences tend to persist in the direction, especially if they're well established. And because of that, you don't want to fight the trend. You don't want to stop this speeding truck with the weight of your body, because it will just run you over, you through, right? So that's something of an important lesson. I had made so many silly, stupid mistakes like that myself, that I would concentrate the trend, that I would try to literally, or maybe not literally, just make those financial decisions just as if I was, to stop this speeding truck, this counter traders trend with some money, believing that my money would change something, to the market. Or of course that was true. That was not true. That was dumb. I was an idiot for thinking this way. And I only wish that your application of relative strength study, which is this comparative analysis and revealing which asset includes more momentum, more leadership, and more preference, and more likely this is going to continue and accelerate, attract more money. Well, then this definitely helps you understand the portfolio management aspects to it. It definitely helps you make money with it, right? And it can definitely have a lot of preceding value, forecasting value, to predict the future trend reversals, as it is driven by the future of by the prices changes of, or actually the imagined future outlook from the traders, right? What the traders imagine for the future to look like. And all that is that you can use that when you compare, let's say, I often ask this question: which one is more bullish? Which one is more bullish, Ethereum or Bitcoin, right? So what is going to happen is you probably will have to either comparatively just observe both, or how distant they are going to be versus that 200-day MA versus 200-day moving average, and the distance of Ethereum is about 12.5%. However, for Bitcoin, it's going to be about, what is it? At this very specific time, it's about 9%. So which one is going to be of more preference? Which one is stronger? Which one is more bullish? The answer, of course, is Ethereum. Ethereum is more bullish, which is that why you would see Ethereum BTC chart in an inclining ascending mode, right? So you can tell that you want to allocate more money on more portfolio weight percentage to assets that outperform versus to assets that perform less, right? Self-promoting trend. And just like that, you can apply the relative strength studies to stocks, to metals, to bonds, to securities, now of any kind, to cryptocurrencies as well, in order to make better, more educated decisions and help you. It's going to help you definitely define risk, control your risk, and cut your losses short. Focus on where the money is sitting and what the preference of the market is. You don't want to counter trade the preference of the big whales, right? You don't want to kind of like force arm the whales who had pumped, for years on the gym. So that's what you want to consider while picking up the cryptos, while allocating strength or weights of your portfolio percentage money risk to specific asset classes. And this one is going to definitely help you make better decisions in the financial world. And before I go, this is something that you want to understand on the short-term basis, that Bitcoin right now has shown this very significant rampant power and strength, and it's now showing a lot of strength where it showed weakness before, right? So what it tells me, to me as a technician, as a market analyst, is that, well, despite there was a rejection at around 21,500, right now we're looking at a little bit of sideways, yes, of a price barrier initial rejection. However, it's consolidating and spending time relatively well when it showed weakness, right? So just maybe there's a little bit of market shift, there's a little bit of market reclaim of these levels when the previous supply cluster. And as long as this rapid rampant, very sharp and uplifting trend going on, and as long as there is, the 20, 40, 45, 24, 45 level that is held at around 2,500s, then it tells me that the trend is valid for the upside, and I would not really want to escape or take profits early, right? I would want to, for my stop loss, that is defined by the market volatility, ATR, and so on, to tell me, where I should just adjust my stop. And my job is to trail up the stop loss of what the volatility shows, because the trends tend to persist, right? When it breaks away and when it breaks out from a range from a previously established frames, then it eventually continues to move in this very aggressive mode. And this is the type of the market that we move to make the most money in. We make money with the volatility. And the biggest volatility comes when there's a significant trend reappearance. So I hope it makes sense. That's not something I would concentrate. You can use this relative strength study to observe not only the distinct leadership and understand where the money is, what the preference is, and which part of the market cycle we are in truly, because we know that whenever there is energy sector kind of like pumping up, this is definitely not something that is very promising for the economy. That's not something that is promising for the stock market overall, and as a whole, tells you a lot about your preference or the capital preservation or the capital spending on investments. By observing XLY versus XLP, you can easily tell that now it's still on the long-term basis risk-off ratio. That the ratio is showing you a lot of risk-off preference, that the market is considered rather unstable, uncertain, and not something that is comfortable to get invested in heavily. You can use that to invest ahead of market, basically breakouts on the relative strength basis, because they tend to precede certain market breakouts on the price basis. And you can use them to observe multiple asset classes in the universe of the entire asset classes, just like on the RGG, to understand which assets are to be preferred on the portfolio management basis, right? So the portfolio managers are going to be logging what shows relative strength versus S&P 500 in the middle, and what shows weakness is going to be shortened or underweight. And all of those things concerned can definitely help you with preferring certain crypto assets and cryptos versus stocks and so many other comparative analysis pieces. Hope that makes sense, everybody. There's been a lot of significance in the relative strength studies. Definitely something that is worth going deeper down the rabbit hole up here. And before I go, this is a kind of reminder that you can still get under my pinned tweet on Twitter at @crypto_burp. You can still get my free membership for your official calls, for your official signals. For the years, this is the 6th year that we are operating as the Burp Nest. 6th year, we have been for the bear market, for the bull market, sideways, recession, wars, recession, war, and everything. And we're still here, right? So this is pretty awesome, pretty cool. I've got an amazing team on my side, and we are honored because on the 5th anniversary last year in December, we were able to unlock this brand new milestone, historical change, that we unlocked one of our main products, the calls only available to public for free as long as you meet certain criteria. And that's it. If you actually just look at the market in a credible technical way, and you see that the market is starting and ramping up into something that is going to be the next bull market, then probably there is a whole ton of opportunities that you're going to miss if you don't have the right tools. And my job, my responsibility is to give back to the community the option to get the right tools. And as the only CMT chart and market technician from my country, I can help you get those tools. And if you go under my Twitter, under my pinned tweet, there's the link, and you can unlock my premium signals for free with this link under thebourbonist.com/COBB, or just simply go ahead and click under my Twitter profile. And that's it. If you go and meet certain criteria, instructions, it's going to be simple, easy, and within 24 hours, you're going to be validated or verified that if you followed all the criteria, all the steps as instructed, you're going to be granted a month, 4 months, or even year, along with other bonuses of free membership, of free premium paid membership, of course, only within our department services. And the yearly cost of it, by the way, is $1,428. It's almost $1,500, almost $1,500. And yet, you can get it for free. So if you're interested, make sure you head over to my Twitter or to thebourbonist.com/COBB. That's where you're going to find it. That's all, folks, I've got for you. Hope you have a brilliant day. Hope you have a blast. God bless you. And if you enjoy this relative strength study, this workshop, make sure you hit the subscribe button, smash the likes, hit the notification bell so that you stay notified, because we've got so much more coming up in 2023 for you. God bless you all. See you around, and bye-bye.